I think that blended finance is certainly a solution, but I think that blended finance is still in its infancy and it has to develop itself. It has to change. It has to learn lessons and it has to sort of evolve into something that it is a lot more flexible and a lot better suited to meet the challenges that we are encountering. I think that we are now in a time of urgency in which, unfortunately, we cannot necessarily dilly-dally anymore around making things perfect. Things are not going to be perfect, but neither is going to be perfect a world in which we are, more than 2 degrees centigrade over what we are now.
Hi, everyone, and welcome to Climate Tech 360, where we connect with diverse voices in the climate sector to make informed choices in supporting the future of climate tech. I'm your host, Samia, and today I'm speaking with Susana Lopez. Susana is the investment director at Climate Fund Managers, or CFM, a leading climate-centric blended finance fund manager, and her focus is on the Latin American region. CFM designs and deploys climate finance funds at scale and at pace, working in partnership to develop climate resilient solutions. The fund currently manages 2 emerging market infrastructure funds focused on climate change mitigation and adaptation. Climate Investor 1, a $1 billion fund focused on renewable energy, and Climate Investor 2, another $1 billion fund focused on water, sanitation, and oceans infrastructure. CFM is also implementing further blended finance initiatives in the green hydrogen, power transmission, and cities sector. Susana has over 18 years of experience in private equity investments focused on infrastructure and climate change. Prior to CFM, Susana was a founding partner of Real Infrastructure, a $120 million renewable energy private equity fund for Latin America. Before Real, she was an investment principal for Wolfson Asset Management and vice president for Conduit Capital Partners. Susana has an MBA from Columbia Business School and spent a significant portion of her career working in New York City. Susana and I were at Columbia Business School at the same time, but it's a 2-year program and we were 1 year apart, so we didn't really cross paths until recently. But it has been amazing to hear about her career since then, that she has dedicated entirely to working in infrastructure and climate. In this episode, we talk about blended finance and how to manage and align the various goals of public, private, and donor capital. We talk about case studies of deals that she's worked on, the due diligence process, and timelines for infrastructure investors. And of course, I had to ask her about the first-of-a-kind financing gap. And we discuss her thoughts on how the market should address this, who should be addressing it, and what skill set is required to make these investments. And now, on to the episode. I would love to hear about what you were thinking when you were in business school and trying to figure out what you want to do next in your career. Because we were there at the same time, and I don't remember anyone talking about clean tech. And also the path to get into it was probably going to be really hard. So when you were back in business school, and for context, for people listening, this was like in the 2005, 6, 7 timeframe, what were you thinking? And then how did you find your way here?
It was interesting. What I was very looking forward to was to work in emerging markets. I wanted to work in something with impact. And I wasn't sure really what shape was going to take. I wasn't sure if I was going to be working on microfinance. I also was leaning sometimes in small and medium enterprises, women issues, fair trade, a lot of different things. And I took a trip. When I first joined Colombia, there was these managers for international development initiatives club that I was a vice president of. And I took a trip with them to Chile. And during the summer, not the summer, during I think it was Christmas break. And then I decided to go over to Bolivia just to check it out. And I took a trip down in Bolivia and I had a lot of terrible adventures, pretty much almost died due to the lack of infrastructure. So at the same time, I was also reading the book, The End of Poverty by Jeffrey Sachs. And then it's when I realized, infrastructure is really the first step. Like he says, the first rung of the ladder to development. And that's when I decided that I wanted to really work on development based on infrastructure. And back in the day, at least from the United States, which is where I was based, there was not a lot of talk about climate or anything like that. In Europe, there was a lot more, but not in the US. My now husband had already been a little bit immersed in that field because he was working for a company that dealt with carbon markets and they were putting together all the CDM transactions for carbon for new projects in infrastructure projects, particularly in Latin America. And I was helping them out with like some translation work and trying to identify developers in the region. And the first CDM transaction actually was a hydro project in Honduras. And he was involved in that certification for CDM for carbon. So then is when I put two and two together, and I was like, this is what I need to do. I need to work on infrastructure, but with a climate focus. I started looking. There was really nobody in the private sector that was doing anything like that. So for my internship, I work very much into getting into international financial institutions like the Inter-American Development Bank and the IFC. And I got very far down the line with the IFC in particular. But then I was talking to some people and they were saying, yeah, IFC is fantastic, but it's very bureaucratic. And I wanted solutions and I wanted things kind of like done, not necessarily just talked about, but really I wanted to have a real impact. So then I started exploring which were the asset managers that were doing anything related with infrastructure in Latin America or in any emerging markets. And I was able to find one. It was called Conduit Capital Partners. And they were pretty much the first private equity or the first, the managers that were managing the first private equity fund in Latin America for infrastructure since the year 93. They had already 3 funds under the track record, and they were nowhere close to considering anything related with climate or renewables or anything like that. So then I went in and I said, I really would like to learn. I want to work with you guys. I want to work on infrastructure development in Latin America in particular. It's great. It's the region that I feel closer with. I started working with them, but I had to do a lot of things that I didn't feel necessarily that I wanted to do. I took it because back in the day, it was not economically feasible to really put together plants, like solar plants were not economical or wind farms either back then. So we were doing some hydro, but also we were doing a lot of heavy fuel oil, like bunker oil in Jamaica and in other places. We were doing coal, we were doing gas. So I did that and I did it. I was always talking to them about how I wanted to just work on renewables and that we had to raise a fund for renewables. And they were laughing at me and they were calling me the tree hugger and they were saying that, go and save the polar bears if you want to. I was like, no, this is really what I want to do. But I'm willing to also learn what is about the other side that I want to fight so badly. And why it makes so much sense now to still build this type of very polluting power plants instead of going for just renewables. Some of them were definitely a lot more efficient than the ones that were running. So that made me feel a little bit better. I was doing, in many cases, even some of them that were financed by the AFC, they were even considering claiming carbon credits because the efficiency of the plant was so much better than the ones that the country had in their energy mix that really made a difference. But it was still bunker oil. And I did that for many years. Yeah. And then I got fed up. And then I decided to start my own asset management firm with one of my colleagues. And we partnered up and we raised a private equity fund for renewables in Latin America and the Caribbean. And since then I never looked back.
So I'm curious, what happened in Bolivia that made you realize that infrastructure was really what needed to be prioritized?
We took a trip to the Pampas, to the area that is closer to the Amazon in Bolivia. And the only way that when we got there, we had to land on an airplane, on a tiny little 2-motor airplane. And there was not really like even a landing strip. We had to land.
That's scary.
Yeah, on a cow pasture because it was pretty stormy and it was raining a lot. And the plane went a little bit all over the place, but that was not the worst of it. When we were coming back, we were supposed to be coming back, the rains were so heavy that the airplane couldn't take off. There were no airplanes leaving the area for many days. So then, and obviously there are people that live there. I mean, I'm not, it's not only for us, for tourists. There is quite a number of communities that live in that area. So then what happened was that we decided to take what is called the death road back to La Paz.
Gosh.
And that was what we found, is that it's a road that only has a space for one car and, at a time. And obviously it's a two-way road. So
Oh,
whenever
God.
you found another car going forward, going towards you, you had to pretty much
Stop.
go to the curve, either go back, like really, the only way to go back was obviously in reverse. So you had to go in reverse to the curve that you had just went through and get a little bit on the edge. And the fall was this much. It was like insanely deep. And then what happened was that we found three landslides as we were driving. One of them made a huge boulder fall right ahead of our car. The trip that was it was like about 200 kilometers, and it took us 18 hours to get back.
Oh my gosh.
It was like literally the most terrified that I've been in my life for my life, because I really thought that I wasn't going to make it in many occasions during that trip.
Yeah, when I was younger, we lived in the global South, and we moved a lot because of my father's job. And I found us in situations like that where we'd go on a family trip, and it was one of those, we'd be going up mountains, and then there'd be a turn, and as you're turning, you see a truck coming. It seemed physically impossible for two cars to be on that same road, much less a truck and a car. And if you were on the edge, it was just terrifying. But yeah, that's how people live.
Yeah, exactly. And that's the reality. If you don't have infrastructure, you cannot bring your products to market. You cannot really make a decent living. And I'm not talking only about roads. If you don't have power that is reliable and
Clean
that
water.
is functioning, and water and all these type of things, you cannot develop industries. You cannot even, there is no way that you can get out of poverty without proper infrastructure. The question is whether if we keep building infrastructure without thinking about the long term, or if we focus on the infrastructure that actually is going to not necessarily ruin the planet, but it's going to bring in good social and economic development without necessarily have an environmental negative impact.
Absolutely. And when you were working on those projects at Conduit, were those also financed did you use blended finance to structure those
No.
deals? No. Okay. That
No,
was only
absolutely not.
afterwards.
Yeah. So most of my career, I've been working on plain vanilla private equity, meaning private investors, institutional investors, most of them, many also international development funds and institutions, which are really the ones that I must say, they really break through the barriers of entry. They are the ones that are willing to take the risk and to really, pave the way for other commercial investors to come in. So, I really appreciate their help and appreciate their effort and how much they do for developing countries in that sense. But they still require the same returns as commercial investors when they go into a regular private equity, like I say, plain vanilla private equity fund. The issue, though, is that, as I have experienced myself, private equity, as it is a type of instrument of investment mechanism that doesn't really tie great with developing new infrastructure projects, because private equity obviously has kind of like the funds have a limited term. Usually it's 5 years investment, 5 years to exit. And to be fully honest, to develop from scratch a project of this magnitude, the type of utility size projects that we're looking at, requires several years just from the beginning to the very end. So that causes a lot of stress because you're not deploying capital sufficiently, fast enough. The idea of blended finance, or at least the idea of blended finance for the fund that I work on now, is to break that a little bit and to expand that period and to have patient development capital first before the construction private equity capital comes in later. So that's one of the ways that they are trying to solve that issue. But no, back in the day, it was only private equity. You had to develop the projects from scratch. Yeah. And everybody was looking just for returns. They were not even major requests or proper. It was not really enforced to provide metrics, impact metric reports. They were asked you for them, like, could you please give me that information? But it was not the basis of their involvement in the transaction to have that impact, those impact metrics come to play.
Got it. We've never talked about blended finance on this podcast before. Can you define it for the audience?
Oh, okay. So blended finance is really a solution to invest, particularly in the field that I work on in private equity, although it can be applied to any other type of investment, in which you bring in different sources of capital with different risk and return profiles to put together sort of like a mix or like a blend of different kind of like cost of capital, for example, and different sort of interest within the different investors to put forward a transaction. So, for example, in our case, we have donor capital, which is the one that first comes in for the development phase. They're patient capital, they're highly risk tolerant, and they're really looking for impact and additionality. They really want to bring to fruition those projects that wouldn't make it otherwise. Those projects that will not have financing for the development, or those projects that really make a difference in terms of impact, but that nobody has really the funding to have that patience for 2 or 3 years until the project is actually ready to be built. And then the construction capital comes in. And the construction capital in our case is formed by 3 different layers of capital. Also donor capital, which is highly concessional layer with low return expectations. And what they want to do is kind of like provide a first loss guarantee to the other sources of capital. They're looking for very stringent and strong impact metrics for our projects. And then we have another layer, which is commercial capital, regular private equity investors. They want high returns. They want low risk. They are used to investing in developed countries, and they are not necessarily, they like, obviously, the investment thesis of emerging markets, but at the same time, they want to be protected. And that's what that original layer that I mentioned about the first loss guarantee provides them, that comfort to be able to enter into these emerging markets and to provide the scalability that the fund needs to be able to really take on a lot of different projects and make a difference. And then the other layer is kind of like a leverage layer for the fund that is also provides also has a sovereign guarantee behind it and everything, and it also kind of like brings it all together nicely. So that's the idea.
And so it's a mix of public and private capital, effectively. The public capital that's been brought in has somewhat concessionary terms in order to de-risk the project so that the private capital can come in. Is that correct?
That is correct. Now, it's not only public and private, it's also philanthropic money.
Mm-hmm. Right, when you say donor capital.
Exactly. So the capital that is providing that additional layer of safety for the private money doesn't necessarily only have to be public. It also can be philanthropic.
And it could be equity, it could be debt, it could be grants, it could be guarantees. Is that correct?
Yeah. In the broader blended finance field, you can have all of that. Actually, as a matter of fact, the idea, we are fundraising now also for debt also instrument that comes in after the construction has been finalized and the project is operating to refinance the projects, to refinance the equity. But in our case, right now, it's only equity. Within the equity that we have at our fund is private equity, we do provide different, for the projects, we do provide a very broad scope of financing, but we always have to have the component of equity, a little bit of quasi-debt or like debt, we sort of call it, but not really. It's more like a convertible or things like that.
Yep. And we were talking about this earlier, but it can be tricky to finance projects, infrastructure projects that way, because you were saying how the goals are different for the different providers, right? So with the concessionary capital, you have impact, and with the private capital, you have returns. How do you deal with this misalignment of interests?
It's the most difficult part of the entire process, really, more than anything, because Obviously, there are projects that have a very strong impact and they really make a difference in terms of the metrics. But in many cases, they don't necessarily have the best returns. And also at the same time, there are cases when, in order for us to bring projects to fruition, we have to make a major effort to also put together social projects around or environmental projects about the project to mitigate the potential negative impact that those projects may have. And that comes at a high cost. It's not cheap to have to put together the entire social, for example, programs that you would like to put together so that there are no to the risk the project, or to put together a project for reforestation, for example, when you have a project that actually has an impact in that regard, or monitoring, things like that. That's very, very costly, when particularly because you want to do it in the long term. You want to do it not only throughout the process when you are holding the asset, but you also want to ensure that you have that upon exit, and that when you're transferring that asset to somebody else, those projects still stay in place. And that has a major impact, for example, on the return. So in order for us to try to figure out how to make these things kind of like confluence and occur in a successful manner and keep everybody happy, what we do is we focus a lot on our involvement during the development of the project. That is the key element that we can try to, if we catch these issues early on and we try to solve them early on, then in most cases we're able to do it in a way that it is not necessarily as expensive, and in a way that also fulfills the needs of our, which are very stringent impact metrics that we have to be able to comply with for every project that we build or that we develop. So early engagement is extremely important, and to be able to try to mitigate the impact from the very, very beginning as much as possible, to mitigate the negative impact, and to kind of like implement those measurements early on so that from the very beginning, the project is put together in a way that kind of like meets everybody's expectations. That is critical. In some cases, unfortunately, that doesn't occur. So we still find that we develop a project and the negative impacts are so high that we unfortunately cannot do it we cannot make it come to fruition in a way that still makes sense for our return expectations. In those cases, we unfortunately have to let that project go. And in some of the cases, it's the other way around. We're like, all right, we have very high returns, but there is no way that we can mitigate the impacts. They are too strong and they are too high. And, even if we put millions of dollars into it, this is not going to come. This is not the type of project that we want to get involved with. So then we also let them go. Early engagement is key, definitely. And that's why our involvement in the early development phases is very important. And we, as a matter of fact, we don't go into a project unless we have an involvement in the development phase. So projects that are really, really ready to build, and for for a developer that says, hey, I have this project, but everything is ready and we need to go, we have to go do a very thorough review. We still get really involved. In some cases that may cause some friction with the developer, because he's like, why are you getting involved in this? This is already all done. And we're like, no, you think it is done, but as a matter of fact, it may be done to start construction. But when you look at it at the long term, you may find that this risk is coming in and that this other issue may come down the line. So we need to sort these things now before we start construction. And sometimes that creates frustration on their side. If they are willing and able to have us enhance the project in that regard, then we'll come in. But we still need to get very involved and really make sure that everything is put in place. The earlier that we get involved, the better.
I always ask my guests to provide examples, because otherwise the discussion becomes really theoretical. And when people are listening and they have no experience with infrastructure projects, they don't know what it means. So to the extent possible, could you give us sort of a high-level example of a project, an infrastructure project in the clean energy space that was successful, and then maybe one that wasn't successful and you had to walk away?
Yeah. So one that, successful, I can give you an example of, for example, a hydro project. We have built several of them, in which it was pretty similar to the example that I put in before. The developer thought that he was ready to build. And it was actually at the time when the interest rates were going up. So this particular developer also was having a hard time finding the financing, the project, the financing, the lending that was a reasonable price back in the day. It was already the rates had gone up, and he was struggling to figure it out. And there was also some other issues in the market at that time. It was better to wait to sign the PPA during construction rather than to sign it prior to construction. It made a lot more economic sense because of the way that the market was moving. And the developer really wanted to do that. And obviously, you cannot close project finance with a bank. You cannot close the borrowing money. You cannot borrow money unless you have a long-term contract already in place. Obviously, we talk to them and we say, we're willing to take the risk of the long-term contract. We're more than happy to do that. This project totally makes sense. It is actually a good project that we would like to get involved. We see the merits of it. But even though you think that you are ready to build, we have to get really involved. We got involved. And it was really painful. There were, obviously, it was located in a region that has a very, very high biodiversity rate.
Yeah, which is a huge problem in hydro.
Yeah. And things that he thought were not going to be, the developer thought that they were not going to be an issue at all, ended up being an issue. And we had to put in place mitigation measurements so that certain species will not be at all impacted by this project. That came at a cost, obviously. He saw how the cost of the project was actually going to be increased, but it still made sense to him because obviously the pricing, quote unquote, of our financing was still a lot better than the pricing of or the cost of borrowing money in the private markets, which was his other alternative option, plus waiting for him to have the PPA signed before identifying, before being able to borrow money. So he saw the merits of us coming in versus the high cost that entailed. And then actually he figured out that the value that we were bringing in that regard was not only limited to the biodiversity issues, which he was a little bit more skeptical about, but also we brought in a lot of value regarding the social communities, the social aspect of the nearby communities and how we got involved with them and how we socialized the project and how we did everything. So finally, that project is going to start construction, I don't know, in a couple of weeks or so. Projects that haven't been successful have been, on the other hand, very similarly, projects in which the developer has determined that we are too much of a pain in the neck to deal with because of all our requirements. And they get tired of it and they cannot deal with that and they don't see the long-term benefits of it. It's very hard to put a value, like an economic value, on these measurements and on these initiatives, so, which it is enhancing the environmental and social aspects of a project. But it is definitely at the risking effect. You're the risking the project tremendously. And that has an economic value that you will see eventually on exit or when you don't have to deal with issues coming down the line. I wish there was a way that we could easily put a value to those so that we could show them to the developers. It's not there yet. We're not there yet. But some of them are able to see it, in terms of security also. We also bring in a lot of health and safety, compliance issues that they have to deal with. And at the beginning, they're a little bit skeptical about it, but then they start saying, oh, they're not that ridiculous. These things kind of like make sense. And eventually, if I can have less accidents within my, my workers, or if I can, prevent some negative interactions with the nearby communities, that also kind of like gives them peace of mind. That's good.
Yeah. I mean, I'm sure that you find that a lot of these developers are not thinking long-term. They're thinking short-term. They just want to execute and they haven't mapped out the risks properly. Is there a way for you to maybe, let's just say with the hydro project, go to them and say, here's a case study on a hydro project we did before where we mapped out the impact it could have had on biodiversity and the social benefits and, how that could have negatively impacted the project long term. And this is the value that we bring to you. If you present it like that, are they more likely to understand?
Yeah. I mean, obviously, we have a lot of experience. I particularly have a lot of experience in this type of projects. So I always bring in my past anecdotes,
Yeah.
which are
Yeah.
many. And in some cases, they are horror stories. And in some cases, they are very successful stories. I don't have, like I was saying before, I don't have a way to put an economic value to these measurements that we implement in the projects. But just by telling them, things that we avoided, that we could have avoided if we had done this in the past in another project in which we didn't, or things like that, they kind of like get an understanding of what it means. It's also very important for us when we come into these type of projects, we don't partner up with developers that want a quick exit, in the sense they want to, for example, the typical developers, what we call them, like trading developers, the developers that put together a project and then once it's ready for construction, they just sell it out. And all they do is develop projects and develop projects. No, we want a long-term partner. We want somebody that actually wants to build a platform and wants to put together a project and stay in for the long term. And eventually, when they see the value of having that project under their portfolio for the long term, and maybe even having us providing them support to build up future projects, they get excited about it. And that's the idea. That's the type of partner that we want to join forces with. Somebody that is here for the long term with us.
Is there any sort of playbook for green infrastructure projects to any extent? Like, are there specific patterns in terms of development timelines and due diligence that you do with these projects that are repeatable?
Every project comes with a different set of challenges and a different set of issues. Plus, we do a very high variety of projects, in the sense that we can do commercial and industrial solar, we can do wind projects, we can do utility size solar, we can do hydro, we can do, the variety of projects that we can take is very different. But having said that, the pathway, I would say, is first we identify the project. Usually we have been in the market for very long, so we have a lot of contacts. People come to us. In some cases, most of the cases, people come to us for the funding. Then we usually take a very quick overview of the project. We find if it has the merits that we would like to any project to really showcase in order for us to take a further look into it. So we do a very basic desk analysis, kind of like socialize it internally. We do something that we call a deal screen, kind of like internally determine whether it is something that we're going to pursue or not. And then we allocate a small amount of funding just to do a high level red flag due diligence. Pretty much technical, social, and environmental and legal due diligence. If that has cleared, or while this is being in process, then we keep working on the desk analysis and we put together a term sheet with the developer. So if we are able to meet commercial terms and to agree on commercial terms, then is when we start kind of like looking closer into the transaction. This is again during development. I'm talking development. So we're not talking about a project that is ready for construction. And then we identify what is the pathway for development, how much funding is needed, what is it that the development requires for the project to come to fruition and to be ready to build. And we go to our investment committee and decide, well, is this something that we want to fund for development or not? And this is what we will be doing and the milestones that will have to be achieved during development for us to keep moving forward with the project or not. With that, if we have an approval, then we have allocated already the amount of development funding that we require, that the project requires, for development to be successful. And then we sign a development funding agreement with the developer, in which we clearly determine who's going to fund what, and who's going to do what, and how the governance of the development phase is going to take place. Like, what type of reporting we require and what type of subcommittees are going to be put in place. Like I mentioned before, for example, our environmental and social committee is extremely important to us, and that's something that we want to be heavily involved in. Once we have agreed on a development funding agreement and we execute it, development starts, or our involvement in the development starts. And we start really monitoring how the development goes, funding, obviously, whatever tasks and whatever steps need to be in place before the construction is ready to to take off. And then during that period of time, we are very heavily involved with the developer. And then once everything is finalized, everything that was set up in the development funding agreement is done, and we have not identified any red flags or anything like that. Everything has gone smoothly and everything is in place. Then we go to our construction committee, investment committee. We present the project. Now we have absolutely all the information. We have mitigated very much most of the risks that will have taken place otherwise during construction. And we ask for the funding for construction. And then at that point in time, if the project is given the green light, then we disperse and the project starts construction. During the construction phase, we are already obviously part of the equity of the project, and we are also very heavily involved in monitoring the construction of the project. And if any issue arises, we obviously take whatever measurements need to be taken, but we are already very much part of the project itself. We are owners, and we take on the role of owners. So we go on the construction and then start the operation. And in our case, like I said, because we don't require financing during construction, we finance everything on our own. Then soon after operation has started, then is when, in our case, it's not necessarily the case for all the projects or all the investors in infrastructure, but in our case, then is when we start looking to refinance the project, to bring in borrowing money for the long-term debt, so that we can exit partially, at least a portion of our capital. And at that point in time, because the project has already been built and already has some operational data, it has been operating for a while. Obviously, the terms of the financing are a lot more attractive than they will be during project finance, and we get a better return.
And in any of these projects, is that concessionary capital? You gave some examples of where the project started out with that. Are there any examples of deals where after you've gotten involved, you have to then bring in additional donor capital?
No. The way, and this is also something very interesting. I wish it was different, but right now, the way our funding is set up is that it is a fixed proportion and it is a fixed timeline. So we bring donor capital during the development phase, and then during the construction phase, the ratio of donor capital or concessional capital to commercial capital, it is fixed also, and it cannot be changed.
Okay.
And I wish it would be different, because there are some instances and some projects for which, like you very well mentioned, concessional capital will be very, very welcome in a later stage of the project or in different proportion than commercial capital. Like there are some projects that, like I mentioned before, they don't necessarily meet, for example, the return thresholds that we're looking at, but the projects are amazing and they really bring in a lot of very needed infrastructure, very needed power, for example, in the case of renewable energy in particular, to an area, and has a lot of very positive social and environmental metrics. But if it doesn't meet the return, even with the blended finance, if it doesn't meet our return threshold, we cannot put it forward. And I wish that we will be able to maneuver with that a little bit different. That would be certainly the best case scenario.
Yeah.
But we cannot do it. It may exist somewhere else, but we cannot do it.
I'm glad that wasn't an idiotic question. As I was asking, I wasn't sure. So
fantastic, yeah.
I wanted to get your perspective on this first of a kind funding gap. We talk about it a lot on this podcast. And, these are projects where there's both technology risk and execution risk. From a risk reward perspective, it's not typical for venture. And then the same goes for infrastructure investors or project finance, because there's tech risk. Someone needs to fill in this gap. And I would like to get your opinion on who you think that needs to be and what skill set you think is required.
Well, this is very interesting. We have been looking at some first of a kind funding. I think that a setup similar to what we have will be ideal, but it will have to be a vehicle that only does first of a kind. Why am I saying that? Because we have a couple of those in our portfolio. in projects in which the technology is there, but there is not yet a pilot project to put it forward or to demonstrate the scalability of the technology. And we have been able and we are willing to fund that in some cases, only in some cases. Now, what are the things that we look at when we consider this type of opportunities? First, we look at whether the technology works, even if it's a small scale, but if it is long-term proven. For example, if it is a process, like an industrial process, and the main portion of it is actually proven and it works perfectly well, but the process that brings all the pieces together has not yet been put together in a scalable manner, we are willing to take that risk because we think, okay, the core technology works. We just have to figure out how the process that brings in the materials or that puts, sets out the energy out or things like that, whether those things will be making sense at a large scale. So that's the first thing, that the core technology is proven, even if it's a small scale. The second thing that we look at is obviously the resources that we ourselves have available. We cannot extend, and that's what I was saying, that it would be great if there was a fund that was exclusively doing that, because we cannot stretch ourselves so much that we have to take a bunch of those projects at one single time, because we still have the regular proven plain infrastructure developments that we have to take care of. And those are obviously the ones that are coming on faster down the line, that we are probably going to be building faster. And obviously where private equity timing is important to us. So we look at the ones that are very, very attractive. And we have, like I mentioned, a couple of those that we are very excited about. Another thing that is important is obviously if we're going to take on technology risk during the development phase, we like to take a portion also on the IP of the technology,
right,
on equity, on that portion. And in some cases, we have been able to justify that, but our investors are looking for infrastructure. And to justify to them the fact that we are also taking IP, equity at the IP holding level, sometimes takes a little bit of explaining to do.
Right.
Where is the exit? What are you gonna do with that? But obviously, we don't want to leave the potential upside on the table. We, particularly we're contributing to the development of the technology, and it is a technology that it is successful. We want a portion of it. So that's also something that in some cases we cannot do on a regular basis or as our base case. It's something that we do extraordinarily. So that's why it would be fantastic to have some sort of blended vehicle that focuses only on first of a kind projects. Something similar to us that only does that. I don't know if something like that.
Right. They're popping up now. So I would imagine effectively a new type of fund structure with people behind it that have the infrastructure expertise, but the deals are set up slightly different to account for the additional risk. So potentially taking a part of the IP, and then the checklist obviously is different. Yeah, I think that would make more sense. Do you think it would be a combination of equity and debt or purely equity?
I think at the stage of development, just equity. But obviously, once the project is scalable, equity and debt.
Yeah.
The thing is, ideally, what I believe would be great, it would be if these type of funds were also then able to bring in the infrastructure capital later on. So what I mean by this is that, okay, you have your pilot project. It's now proven, has been developed. It works great. I still don't see a lot of infrastructure funds coming in to put together the actual infrastructure size projects in these markets. So I think that at least the first couple of infrastructure projects that are not anymore first of a kind, but like first, second, and third of a kind, will have to be done will have to be funded by the same investor, because typical infrastructure funds or infrastructure financing, I don't see them coming into a second or third of a kind. Still, probably will want to go into the fourth or fifth.
Yeah. But I would think that you need the skill set that an infrastructure investment professional has in order to due diligence these projects.
Yeah. You definitely do. That's what I'm saying. It would be great if it was something similar to what we have, but that we will only do in first of a kind, so that we could do 7 different projects, pilot projects for new technologies, and then we build, we replicate them on an infrastructure scale, each one of them in one or two instances, like, I don't know, plastic processing technology. Let's give an example. Or like modular type of new solar technology. Okay, you have built it, you have put together the pilot project, but now let's go and let's actually build 4 or 5 of those plants, or 3 or 2, whatever, a number of them, as infrastructure investors, the same fund, but as infrastructure. And we bring in then at that point in time in the infrastructure play of it, we bring in not only equity, but also debt. That's the point when I bring in debt. And then once we have built 4 or 5 or 3 or 4, that's when the big infrastructure players come in, the Macquaries and all these big guys. And then the project can take off, that technology can take off, for good.
Yeah.
But I think that the first team that builds the pilot has to be the team that builds the first, the second and third actual infrastructure size projects of these technologies.
And I was telling you about Vargas Holdings, which I know you're not familiar with because your focus is on Latin America, but they have financed some of these first of a kind projects, not even in pilot stage, but they brought in a bunch of infrastructure funds. And from what I can tell, it's because they have these massive offtake agreements. Like they just set up a company called Sire with H&M, where H&M had a 600 million offtake agreement. And in that scenario, do you see it as much more likely that infrastructure funds would get involved from the very early stages?
I think technology risk is still something that infrastructure funds will not be willing to undertake, unless somebody like Vargas who's willing to do a sort of structuring in which they take on the risk of the first few projects or the technology risk. I don't see infrastructure players taking on technology risk. No, not the ones that I know. Obviously, things are changing, but not the ones that I know. They want to do what they know works. Infrastructure funding is one of the most risk-averse fundings that you can imagine.
Yeah.
It's not regular private equity. It is not at all venture capital. They want everything fully contracted, the technology being tested and proven. And I don't know. It would be interesting to see what the Vargas team can do in that regard. Maybe they're willing to, maybe they are able to convince the infrastructure investors. I know that at least in my past experience, that will be something that the funds that I work in and the ones that I collaborated with as partners in other transactions or co-investors or things like that, I will not even consider that.
Yeah. It's something worth digging into.
Yeah.
Next time I have one of them on, I will definitely ask that question. Okay. So you obviously have this perspective that not a lot of investors have. You've been in the space for so long, for almost 2 decades, and you've watched this transition from green tech into climate, what is now called climate tech. What do you think is the best mechanism to invest in the climate transition as it relates to this hardware heavy or CapEx heavy companies on the basis of what you've seen so far in the last two decades?
Well, unfortunately, I have to say that, like I mentioned before, private equity or the private equity type of instruments or funds that are in place, they are not a good match for infrastructure. Infrastructure funds are not a good match for new project or new technologies development. So there has to be a solution. I think that blended finance is certainly a solution, but I think that blended finance is still in its infancy and it has to develop itself. It has to change. It has to learn lessons and it has to sort of evolve into something that it is a lot more flexible and a lot better suited to meet the challenges that we are encountering. I think that we are now in a time of urgency in which, unfortunately, we cannot necessarily dilly-dally anymore around making things perfect. Things are not going to be perfect, but neither is going to be perfect a world in which we are, more than 2 degrees centigrade over what we are now. And the impact is going to be negative in whether we like it or not. In some cases, we have to bite the bullet and do things that are not necessarily popular or that are not necessarily great. but we have to really take action. So I think blended finance is a good solution. I think certainly more development funds, more donor capitals in which development funding is put together to work to bring projects to fruition is critical. I don't see a lot of them necessarily, and I would like to see a lot more. But not necessarily, like I was saying before, we have to, and this is something that is, maybe I don't know, maybe I'm going to regret saying this, but we cannot look for perfection. There are some cases when things are not going to look great. And I hate saying this, but there are projects in which you're going to have to take action, whether if the project is maybe having not the metrics, all the metrics, the impact metrics that you would like. They are not necessarily all of them met, but still the project is a good project in the sense that it brings in the solution, the infrastructure solution that the people need. Well, you still have to do it, I think, in some cases. Not all of them, but some cases. And then a way in which you can, like I was saying before, you can customize or you can tailor the blended financing mix according to the mix of the project, the needs of the project. That I think is really important. The fund that I work with is fantastic and it does amazing things. But I think that if we were able to really tailor the blending or the financing the blending of finance that we will be using for each one of the projects, we will be absolutely excellent.
Yeah.
It will be just another
next
level.
Step. Yeah. All right. Final question I have for you. Green hedging instruments. I know that you've done a lot of work on this. Can you tell us a little bit more about the work that you've done?
Well, I wish I had done more work than what I've done. I've been trying to get involved with this and try to put together some instruments for that with some banks and some financial institutions. And I was not very successful, to be honest. But fortunately, there are some people that have. The idea here is that obviously one of the major issues for commercial investors to enter into emerging markets is the foreign currency risk, the fluctuation. If you look at it for a very, very long-term point of view, those fluctuations obviously wash off each other, If you kind of put together a fund in which all the different hedging mechanisms work together, you will see that once this currency goes down, this other goes up. And, in a very long term, the impact has been not as great as people will have imagined. So the same way that we have green financing, green hedging will be a great solution for it if there was somebody that was willing to take on that risk or to partially cover that risk for investors. The IDB, the Inter-American Development Bank, has put together such mechanism with the Central Bank of Brazil for the Brazilian real. And I think that is going to completely revolutionize the way that investors see investing in Brazil. For example, if we were able to replicate that in other markets, then it will bring so much more capital into these markets that are really the ones that are in most need of infrastructure at this point in time, and the ones in which we have to determine whether the infrastructure is going to be green infrastructure or it's going to be gray infrastructure. So if we are able to attract these investors into emerging markets for green projects at scale and at pace so that we can do it fast enough, then it will make definitely a huge impact in the development of these economies and the development of the infrastructure of these economies. We don't have that issue in developed markets. We don't have that issue of hedging currency in Europe or in the United States. But like you mentioned before, the global South is really suffering from this lack of infrastructure. And again, unless they bring in huge amounts of capital at scale, they are not going to be able to just put forward all the infrastructure plans and infrastructure needs that they require just by the funding, from the funding of development financial institutions. They need commercial capital. They need the big pension plans, the big endowments, and that's a major way to mitigate their perceived risk. So yeah, I love to see that coming in more countries and making a big difference in that regard.
Great. Thank you so much for this conversation. But mostly, thank you for all the work that you've been doing for the last 2 decades.
Thank you.
It's kind of crazy to think about your experience in Bolivia and what you went through and the fact that you were reading that Jeffrey Sachs book and how that brought you to this career, right?
Yeah. It's many, looking back in the day, it was very novel. Nobody was really talking about these type of things. Only Jeff Sachs was really the one that was having these type of conversations, at least in the United States, which is where I was living back in the day. In Europe, it was different. In Europe, there was a lot more talk about these things. But it has changed so much in the last 20 years. It's amazing. I wish I could be even having ahead of me, 30 more years to work on this, but I hope that I don't have to. I hope that in a few years, we're able to sort this out. That would be great. I love to work in an industry that self-cannibalizes itself, and that eventually is not needed anymore because we have sorted it out.
Yeah, exactly.
That would be the best case scenario.
And that is it for today's episode with Susana Lopez. If you found this episode useful, then please rate and subscribe, as it makes it easier for other people to find the podcast. Thank you for listening, and I will catch you at the next one. Bye.